Welcome to Get Rich Education. I'm your host, Keith Weinhold. The value of an American home just surged 8.5% to break through a new milestone. In the pandemic, more tenants are paying the rent than you might have thought. Then economic forecaster Harry Dent joins us to discuss the future of real estate and why he thinks stocks are dropping 80 to 85% in value. Where are all the big risks? Today on Get Rich Education. Fortunately for you, Congress has made it possible to get up to $200,000 out of your current 401k or TSP to invest in real estate or your own business, and that's even if you're still working. The thing is, you can get all this money tax-free. The EQRP is your secret weapon. With the CARES Act expiring soon, the EQRP company helps you unleash your retirement funds now. Learn more and text message QRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Here it is. Hey, welcome in to Get Rich Education, episode 308. I'm your host, Keith Weinhold. There's so much to update you on in the real estate world before we get to our guest, Harry Dent, where he is going to make some predictions and point out why the stock market is poised to fall 80 to 85%. Importantly, the proportion of tenants paying the rent payments are near normal levels despite the pandemic-related job losses. There's some good news. This is according to the rent payment tracker from the National Multifamily Housing Council, so bear in mind that we always need to keep the context of just what a statistic means. So this is for professionally managed market rate apartment properties, so it's not single-family rental homes here, but this is a good indicator. Through the 13th day of this month, 87% of American apartment households had paid the rent, and that is compared to 89% over the same period last year. So it's only running 2% less despite today's higher unemployment rate. Yes, that's some good news. Now, overall, I don't think that either 87% or 89% of tenants paying by the 13th day of the month sounds that great, but some owners and landlords manage more passively than others. And remember, this statistic would include the lowest end Class D properties, which are ones that we avoid. Also understand that these are apartment numbers. Though I don't have the commensurate figure for rental single-family homes, I would expect it to be running higher than the apartment number is. But the data shows the apartments are running near normal, even in the absence of any direct federal stimulus. Aside from a federal stimulus plan, CNBC reports that more than half of states are now approved for an extra $300 per week in unemployment insurance that can enable more tenants to pay the rent until that next federal relief bill is approved one of these days, I guess. We'll see. Last week, I mentioned to you that lumber prices are up, and that's an input into the price of homes. Well, in just a minute, I've got an update on how much the price of an existing American home has shot up. But before revealing that, here is an input into it. The recent spike in softwood lumber prices has caused the price of an average new single-family home to increase by $16,148 just since April. That's according to the National Association of Home Builders' standard estimates of lumber used to build the average home. So more than $16,000 higher over a short time span. Look, that makes the replacement cost for virtually every piece of real estate that you currently own go up higher, increasing the value of that real estate that you already own. Yeah, lumber, so not a small component in home construction here. We're talking about the construction of your property's structural framing, and that includes beams, joists, headers, rafters, and trusses. And we're also talking about your property's other components like sheathing, flooring and underlayment, interior wall and ceiling finishing, cabinets, doors, windows, roofing, siding, soffit, and fascia. And then there are your property's exterior features too, like garages, porches, decks, railing, and even any fences at your properties. Yeah, it's all lumber. Remember a couple months ago, we had a listener write in and refer to real estate as packaged commodities investing? I love that. Within your leverage and your cash flow and those up to 5 ways you're paid, you also own commodities with each piece of property that you add. Things like steel, concrete, copper wire, various metals, and yes, plenty of lumber. And think about it, you're also leveraging those too when you get a loan. Well, this price increase overall in American homes is partially due to that increase in lumber costs. So let's talk about what the home values have done. This is really a major milestone to announce here. Again, it's so important to give context with statistics. This differs a bit with the appreciation that I discussed last week. What we're talking about here is the appreciation rate in existing single-family homes, townhomes, and condos. Okay, so note that new construction homes are excluded. This is the median price year over year, July to July. First, to whet your appetite, the volume of sales jumped 25% over about this same time period here. So sales are brisk. You probably already know that. Here it is. The home price jumped 8.5% from a year ago, according to the NAR. Yeah, 8.5%. This jump means that the American home, and again, to be clear, this is existing single-family homes, townhomes, and condos, it's shot past the $300,000 milestone for the first time in United States history, and it is now up to $304,100 with this 8.5% year-over-year gain. Now, to update you on just how scarce the scarce inventory really is, I think you know that when homes are on the for sale market for more than 6 months, that's seen as a slow market, or you'll hear that called a buyer's market. 6 months of inventory exactly is a balanced market, and less than 6 months of available inventory, that's a strong real estate market, or you'll hear realtors call it a seller's market because properties are fast to sell. Well, in July of last year, so a little over a year ago, national supply was at 4.2 months. Today, it is down below 4 months, down below 3.5 months. Unsold housing inventory is currently at just 3.1 months. Gosh, so first of all, you need to congratulate yourself if you've been putting the type of properties in your portfolio that you've been getting through greturnkey.com. I've got to say, since the inception of this show, I've discussed how residential real estate, especially those 1 to 4 unit properties, they are the most recession resilient ones. The demographics work, the utility is undeniable, the interest rates are even favorable. And again, get pre-approved with your mortgage lender and get started at greturnkey.com. Yeah, you can say I've gotten the recession resilient assets part right so far, but I've got to tell you, I really didn't know that prices would hold up this well in a substantial recession like this. And again, of course, the pandemic is not over, so we'll see what happens. Of course, be mindful that in a real estate market as big as the United States, the rewards for home price appreciation are certainly uneven for you. Each market you're invested in is almost surely going to have appreciation either greater or less than 8.5%. Congratulations to you, the action taker out there. Now, Fannie Mae and Freddie Mac have decided to delay the start date of its annoying 0.5% refinance fee that I mentioned to you last week about staying tuned in on. They've now delayed that until December 1st. Yes, that fee is both delayed and it's limited. By limited, what I mean is that this refinance fee will exclude loan amounts under $125,000. All right, so since that's the loan amount, if you're pulling cash out of a rental property at a 70% loan-to-value ratio, then that's a property value of $175 to $180K. So even if the annoying 0.5%, what they're calling an adverse market fee, even if it does stick and start December 1st, property values of up to, say, 175K plus or minus, something like that, they're not going to be affected, and properties over that value will, just approximately. But again, the 0.5% fee applies to the loan amount, not the property value. So what's really going on here is that Fannie and Freddie have to make up for lost money on forbearance defaults. That's what's really happening here. I've talked about the widening gap between the haves and have-nots lately. Well, my view is that this is like the haves transferring money to the have-nots here. If you think about it, if this fee ends up occurring, those that have the credit and balance sheet to refinance are helping bail out and subsidize those people that defaulted. So avoid it if you can and refinance by December 1st, and you're probably going to get a great rate at the same time. And to be clear, this does not apply to new purchases, only refinances. Well, one of the more prominent global economic forecasters, Harry Dent, will be with us shortly. Harry knows how to parse real estate because he knows what we do here at Get Rich Education. We're about residential real estate in stable markets. We don't look at commercial property very much, and we sure don't look at high-flying appreciation on the coasts very much. And Harry does get animated. You might hear him get fired up and smacking things around, which I hope won't cause too much distortion in your headphones. Hey, you gotta love some passion with your economics. We'll discuss stocks a little bit too. I can tell you that short positions in U.S. stocks have reached their lowest level in more than a decade. And what is a short position? What does it mean when an investor says that they're shorting a stock anyway? That just means that an investor is betting that a stock's price will fall. That's really all that means. And it makes sense if you think about it. It means that an investor is not willing to go long with the stock, meaning that they would feel good about it. That investor instead wants to short the stock, again, meaning that they think the price will fall. That might be an easy way for you to remember what you just learned. Just a word about predictions before we get started with Harry Dent. Harry is a prognosticator, a soothsayer, if you will. He makes a lot of specific predictions that also have a timeline associated with them. And look, even Harry will tell you that he hasn't gotten all of his predictions right. My guidance to you here is you can focus on the specific prediction if you'd like to or not. But what I tend to do is focus more on the reason behind why the prediction was made rather than the prediction itself. Let's hear from Harry Dent. Today's guest has been one of the world's most popular authors on the economy and demographics for decades. He owns an MBA from Harvard Business School, and there's a good chance that you've seen him on your television and elsewhere over the years, including where today he's a regular guest on America's Nightly Scorecard. That's on the Fox Business Channel. He has authored his newest book called 0 Hour, and that book is subtitled How to Turn the Greatest Political and Financial Upheaval in Modern History to Your Advantage. And you can always get his updates at harrydent.com. It's been nearly 4 years since you were last here. Welcome back to Get Rich Education, Harry Dent.
Nice to be back, Keith.
Harry, so much has transpired in America and around the world since you were last here. In fact, we never knew exactly how the economic expansion would end, but that longest economic expansion in American history, a run of more than 10 years, unprecedented, that ended, as we know, earlier this year due to really a government-imposed economic shutdown from the COVID pandemic. So where would you even like to begin with what investors need to know today, Harry?
First thing to understand, this is the biggest misunderstanding right now. Everybody thinks this recent crash is about the virus. Now, the virus did trigger it. Virus was the reason, but the virus is just the perfect trigger for a crash that has been building to happen for years, because since the 2009 bottom, the Great Recession, which was looking like the Great Depression, which we forecast it would be just before it happened in 2006 and 7, they just printed trillions and trillions and trillions of dollars to blow us out of that. And when that means we did not get to deleverage excessive debt, didn't get to wipe out zombie companies and bad debts, which you're supposed to do, which makes you healthy again. Real estate came down, but came right back. Stocks came down and then went higher than ever. I mean, this is the most artificial rally in all of history. The only other one to compare would have been 32 to 37. They did some money printing there, but it doesn't even compare to what they did here in globally. So this is an artificial recovery. The baby boom generation was done buying real estate in 2006, had peaked in their spending, and normally for stocks in 2007. And so they rekindled this thing and made a boom out of high financial assets. People understand, not only do we have a lot more debt in the world because of all this low interest rates and money circulating around and easy money, financial assets are worth double. If you take real estate and stocks and bonds and things like gold and silver and add it all up, it's like double what it was at the top of the last boom. So the last boom, we had a debt problem, especially in real estate, subprime mortgages. And once the subprime mortgages went bad, all types of debt started going bad and all types of derivatives, you had a big crash. You know what the problem is this time? The financial assets are so blown up that just a stock market crash, if it lasted longer than the 5 weeks we just saw, and I see a 2-year one coming, would cause a deep downturn because so much wealth is, remember this number, 477 trillion. I've been working on this for months to get this number as right as I can of financial assets. And I had the hardest thing to put in was personal real estate. 477 trillion in a downturn like this. And in the 1930s, 50% of that tends to disappear. That's $40 trillion just goes boom. That's so much more. Global GDP's 80. So that's 3 times global GDP. Same thing in the U.S., 125 trillion in financial assets, which would go down to about 60. So 60-some trillion. That's 3 times our GDP. This is going to be a big reset in financial assets. And, of course, real estate is a financial asset. The sector that will hold up the best in real estate will be the cash flow positive multi-financial sector. And now, people renting homes, negative gearing in San Francisco or Manhattan, no. The property will go down and your rents will go down. But in the places with positive cash flow, real estate prices will go down some, like for apartments and multifamilies. But I'm saying this will be the opportunity like it was for hedge funds in the Great Recession in 2008 and 9, when real estate went down strong for the first time since the Great Depression. The hedge funds and smart investors came in and bought not just apartments, but they bought single-family homes for nothing, rented them out because rentals were more in favor after that downturn. And then as the boom turns around, you can sell them at appreciated prices into the next boom or bubble. So I think that's the best play. A lot of real estate, the mansions, commercial, COVID just destroyed commercial real estate. Dead. We're not going to need nearly as much of that ever again. McMansions are the last things the baby boomers bought, the most overvalued, and the most unneeded now that baby boomers are older and downsizing, if anything. One of the things, Keith, I just did a apartment conference in Dallas last year, and I had to do a little extra homework.
Yeah.
And I'm like, I was shocked. I've been saying for a long time, the millennial generation, born between 75 and 1990, their rising surge, the strongest. They're about done with their rental as young new families. But that peaks around 27, 28 before people get married, start to have kids, and start to buy houses. What I found is there's a new rental class. It's called aging baby boomers that don't have a big enough retirement plan, and so act by they're being forced. This is not intelligence. They never save for retirement. That's why they got this retirement problem. And they realized, oh my God, we got this big house now that our kids have less. We're 50 or 60. We're getting near retirement or maybe in retirement. We don't need this big house. It's worth a lot. We paid off most of the mortgage. Why don't we sell this pig and create an instant retirement plan, which means to do that fully. They don't just downsize from a 4-bedroom house to a 2-bedroom townhouse. They rent the retirement house. More baby boomers are deciding to sell their main home and rent in retirement for flexibility anyway, lower cost. But they realize we will not have a viable retirement plan if we sell our McMansion. Let's say we sell it for $500,000 and then buy a smaller home for $300,000. Oh, we only get $200,000. That's not enough to retire on. So this is the new trend. The over 60 group is going to dominate multifamily rentals. And you know what's good about these people? They're not on crack. and heroin and throwing parties every night and burning down your home or your apartment you're renting to them. They stay with you longer. Once somebody retires at 63 on average, they make it that late, they're going to live, particularly women, until the mid-80s. They could stay with you for decades. They are higher income, more reliable, and they want more services and will pay for quality. And they want dog sitters and plant waterers and blah, blah, blah. So it's a better market for rentals, and it's one that never existed before because old people typically either stay in their home forever or they downsize and then stay in that home. Older people would not rent. That's not something dignified to do. Well, baby boomers didn't save, so they're having to rent. So this is a really cool trend. So that tells me, and I got 3 prongs for real estate.
Before we get into those, to your point, you're right. I mean, we have the second largest generation, the baby boomers. These retirees, I mean, they've generally found renting to be a more acceptable thing where they don't want to have to spend every weekend at Home Depot or Lowe's fixing up their place. And then you talk about the millennials, who is the largest generation in American history, and they are right in prime home buying age right now. So those are what the 2 biggest demographic groups are doing, and they're both serving real estate.
Yeah, baby boomers are moving into retirement, already have started, clearly. And the millennials are moving into starter home buying and down the road, main home buying again. But let me stress something, Keith. The baby boom as a wave of people, the wave is like a 10-foot wave. The Bob Hope, World War II generation before them was like a 3-foot wave. The millennials, as many as they are, they're born over a longer stretch of time, but nowhere near as steep because they're like a 4-foot wave. I tell everybody, any consumer marketing segment, if you can take your product or service to the aging baby boomers who are higher wealth for sure and income more than average than the millennials who are younger and less so, but you're going to have a stronger growth curve. And in my number one growth market for consumer spending in the coming 2 decades is nursing homes and assisted living facilities. The last thing aging baby boomers will do in massive numbers. That means the baby boomers are a better market for real estate than millennials just because it's just such a stronger growth trend.
Yeah, that is the end game for a lot of people. With what's happening with the Fed trying to resuscitate the economy and us seeing these unprecedented injections of monetary stimulus to try to keep the economy afloat, what's really interesting, a lot of economists are with the Austrian school of economics, laissez-faire economics, leave it alone, let the free market take care of itself.
Let the free markets figure it out, not a bunch of economists who never had sex or run a business.
Laissez-faire economics right now would cause a lot of pain for a lot of people. Yeah. Someone more Keynesian on the other side might be more with us making all these injections. And we're making injections of so many trillions of dollars. The word trillion is floating around so often. You brought up 477 trillion earlier, Harry. Sometimes I wonder, when are we going to start using the word?
It's even hard for me to believe that number when I figured out. I knew it was high. I knew it used to be 220 or 50 or something. This is crazy. This is the most insane thing ever done in economics and history outside on a smaller scale, the South Seas bubble, where the English government was in debt from a bad war and basically sold their ownership in the South Seas Company, which was their monopoly on trade in South America that they got from Spain. They sold this to the public at inflated prices and gave easy financing and low interest, all this stupid stuff. Anybody with an arm and a leg could borrow money at almost zero rate and created the greatest bubble that burst back then. The first stock bubble to ever burst. It was a 98% burst. This is the craziest thing. You don't get out of a downturn successfully by just printing money and having it go away. That's magic. If printing money was the way to grow an economy, then why have we been working? Why have we been investing? Just let the government print money, give everybody $50,000 a year or whatever, blah, blah, blah. Oh, just print money to pay your government bills, and then whatever. This is insanity. And the problem, you can see the problem if you look at it, between 2009 and the end of 2014, about 6 years, a little over 6 years, they printed almost $4 trillion. Not counting fiscal stimulus and deficits, that's another so many trillion. $4 trillion to get this economy to just grow 2%, the lowest recovery rate ever, abysmal recovery, 2% with that much stimulus. Look what they had to do between the repo crisis in late 2019 and the COVID crisis, early 2019, they printed $3.5 trillion in 8 months. So you see the exponential rate. You have to print exponentially more. It's just the classic addiction cycle. It takes more and more heroin, to keep from coming down and get high again. More and more alcohol, more and more crack, whatever. I mean, it does not work. My prediction is in the next 2 to 3 years, we're going to see it doesn't work. And you know what my prediction, other than an 80% plus stock crash, and I'll tell you right now, by the end of 2022, give or take, I've had that target for 20 years, by the way, with the lowest stock market in our lifetimes because of our demographic cycles and some other cycles. I think the Federal Reserve is going to lose their jobs. I would love it. We don't need these people. We didn't have a central bank from Andrew Jackson up until 1913, and then they create the Federal Reserve in 1913. Guess what? 20 years later, you got the Roaring '20s bubble, the greatest bubble up to that point, and then the Great Depression crash and the greatest depression in modern history and in U.S. history. Central banks don't let the economy laissez-faire, free market style, grow and then restructure and get healthy and then flush out bad companies and bad debt. That's healthy. It's like having a cold every month or so. You get a cold. You don't catch a cold. You catch a flu or you catch the coronavirus. A cold is internally generated by your body when you have too much toxins or stress or something you need to get rid of. It makes you healthy. So the economy doesn't get to rebalance. It keeps getting stretched and stretched and stretched, like in the run. Then you get pneumonia instead of a cold, and that's called the Great Depression.
Sure. The higher we artificially prop it up, the further it will have to eventually fall. Yes, a free market economist would say, no, don't let the Fed intervene and don't let them print any more money. And then some people will wonder, well, what are we going to do about the unemployment? Well, what the free market economist would say is, well, you would not shut the economy down either. Therefore, you would not need to create all this printing. Harry Dent and I are going to come back. We're going to learn more about why he thinks an 80% plus stock crash is possible. You're listening to Get Rich Education. Our guest is Harry Dent. More when we come back. I'm your host, Keith Weinhold. Property investors can get killed with maintenance costs. That's less likely when you buy brand new construction. Let me tell you about JWB Real Estate Capital in bustling Jacksonville, Florida. They pioneered the build-to-rent model where you can invest in new construction, turnkey rental property. That's why JWB was featured on the front page of the Wall Street Journal. To learn more and see inventory, start now at newconstructionturnkey.com. The people that our listeners can't stop talking about are Ridge Lending Group and MLS 42056. They provided you with more loans than anyone. It's where I got my last few loans, and they finance single-family income property up to fourplexes. They're the #1 lender for both beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and you'll end up with your custom plan for expanding your cash flowing portfolio. Start at ridgelendinggroup.com.
This is author Kristen Tate. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're having an economic discussion with Harry Dent. You can learn more about him at harrydent.com. He's such a prolific author. His latest book is called 0 Hour. So, Harry, you talked about a potential 80% plus crash in the stock market. And even though we're predominantly real estate investors here, that does affect us, and it affects everyone because it affects everyone's psyche and everyone's wealth effect. And when people feel poor in the retirement account or wherever else, they're less likely to make consumer purchases and real estate purchases and everything else. So tell us more about why you think stocks could crash more than 80% in the next couple of years.
Yeah, and real quickly, stocks are the best leading indicator of the economy by about 6 months or so. And so if stocks go down that much, you're going to have a deep downturn that's not going to be caused temporarily by the coronavirus. And real estate's in a bubble too, the second real estate bubble. This is the third stock bubble, by the way. And we're going to have a bubble crash that will revaluate all financial assets lower. So the people who get out of financial assets near the top and then reinvest at the bottom are going to become overnight extreme wealth. That's what Joseph Kennedy did, late 29 to 32. He got out of the stock market, got back in, and he was a mere multimillionaire in 1929. He became a billionaire, political dynasty after that. A lot of that from that shift. General Motors was a distant number 2 to Ford. And then in the downturn was more lean and mean and focused and bypassed Ford forever. So this is the biggest opportunity. Now, why stocks are going to do this? They have bubbled up. Again, totally artificial. The economy's the worst it's been. I've got the best leading indicator for what the stock market should be. It's called the spending wave. 46-year lag forward for the peak spending of the average person. It's now 47 for the millennials, so that has shifted. But by my indicator, the stock market in February, when it peaked, was 120% overvalued. When I measured gold versus commodities and other precious metals, it's 50 to 60% overvalued. Real estate, I have an indicator that projects net demand, peak buyers, less dyers who are sellers, which I can do demographically out for decades, says real estate was overvalued 20% at the top in 2006 last time. This time it's overvalued 42%. So we're going to have a bigger real estate crash, maybe 40 to 50% instead of 34 last time. Last time stocks went down, I think 54%. I'm projecting more like 85% this time, similar to 1929 to 32. What it says, Keith, very simple. The whole economy goes down. Again, no longer because of the virus. This virus is going to be pretty much a nothing burger by the election. It's already decelerating for the second time, and I hope we don't go for third. I hope we're not that dumb. We're the dumbest people in the world, by the way. Everybody else beat the virus, got the lesson, did the right thing, and didn't have it come back and smack them twice as hard. Nope, we just went out, drank, went on the beach, whatever.
There are America's ideals of freedom and liberty right there.
Want me to wear a mask? Tell that to my shotgun. That's America, okay? Not our best trait there. So this is a huge opportunity. I tell people, I've been saying this, I've been predicting this winter season, big crash, depression, reset in financial crisis, because it happens every other generation. And it particularly happens every 90 years on a technology cycle. So I've been predicting this for decades. Well, this is it. Normally, you'd have had the worst crash in 2008 to 10, not 8 to early 9. They cut that downturn in half, and it would have been like 29 to 32. Then you would have had a second depression, less worse, at the end, 2020 to 22. Well, we got the lesser crash. Now we're going to get the bigger crash at the end. It means businesses that hunker down will gain market share rapidly at the expense of failing competitors, people in the real estate industry that get out of overvalued real estate. Either you're in cash flow positive real estate, or you sell real estate that's overvalued and have a pile of cash. Cash and cash flow allows you to take over properties in foreclosure and at much lower prices in the downturn. Like literally walk into a bank in foreclosure and take over an apartment building or a single family house that's easily rentable out for maybe 40, 50% less than it was, and not even have to put any money down. All you do is take over a portion of the mortgage, and you do it either because you got cash to walk and do it, or you say, I've got cash flow, so I can make this payment. There aren't going to be many people the banks can turn to and say, why would I give it to somebody else who can't make the payment? Oh, I've got positive cash flow. I got a bunch of rental buildings that are throwing out cash flow, and guess what? Renters go up in a downturn like this. One warning, stocks will go down a lot. Real estate will go down maybe 40 to 50%. Varies a lot, high end more, coast more than central, all that sort of stuff. Yeah. I tell people, Keith, the best indicator, I tell people, what was your real estate worth at the bottom of the last recession, 2009 to 2011, depending on the area. That or a little bit lower is your downside potential. So you can estimate that in advance, including your apartment building, single family home, a big mansion, a commercial building, etc.
I'm glad you've segmented out this potential second real estate bubble somewhat by coast and by inland real estate and by real estate that's bought for appreciation potential, like what's often done on the coast, and real estate that's often bought for cash flow potential. One thing I like to keep in mind with real estate, whenever we look at long-term price histories, you're comparing it to 2006, of course, we're thinking about, well, what's the inflation-adjusted value of that real estate? And also, for a lot of investors, 80% of the purchase price of the real estate is really about that payment, because that's the amount that's being borrowed. And of course, that payment amount is substantially lower now. And that's a substantial input into the affordability and the price of a home. But can you speak more to what you think about the potential resilience, if we are in a real estate bubble, of those markets in the Midwest and South, where one typically buys for cash flow? And even when a market's doing well, those markets don't appreciate a lot, but they tend to be more recession resilient as well. What do you think about those cash flowing residential properties in the U.S. Midwest and South?
That's about the only place you can buy cash flow positive real estate.
Right.
You can't do that. I lived in California 22 years. People like renting it out for 60% of their carrying costs and hoping to keep making it on appreciation. That's a bad business model.
Yeah, that's speculation,
It's going to fail one day. It is the Midwest and Southeast, in some parts of the Rockies, that you can do this. And just the fact that a property is cash flow positive means you're not bubbly or you're not that bubbly. So the places that are most bubbly will not be positive cash flow, and that's how you measure that. And I also say, here's another huge misperception by the richest people in the world. The richest people think the greatest cities, the greatest apartments or condos, the greatest houses, the greatest office buildings will never go down because they're so great. No, the greatest places bubble the most. The greater the bubble, the greater the burst. I got 10 principles of bubbles. That's the most important one. That's why I tell people, look back at what you really bought. The worst case is what was it worth at the beginning of 2000. The best case, what was it worth at the bottom around 2010, 11 for most real estate. That's your downside. And the more it went up since then, the more it's going to go down. And the good thing, the Midwest and Southeastern properties did not bubble as much. That's why it's the best real estate. And so you can rent it during the downturn, and that gives you cash flow to be healthy enough to take over more properties that are failing, other houses or apartment buildings like the ones you have. If you have some properties that are more marginal and are maybe more overvalued, or you look at that price in 2009, 10 and say, oh my God, I don't want to take that hit, sell it and then rebuy a similar apartment or house to rent a couple of years from now when things go down. So this is huge leverage. This is what the best hedge funds did in the 2008-9 crisis. They were buying apartments, but they were more buying single-family homes because those were the ones that were coming up for foreclosure. And then renting them out for years. And then when the bubble came back, sell them at a profit. What better business model than that? Rent out, positive cash flow, buy them so cheap so you got better rent ratios. And then down the road, you sell them at a profit. Difference next time, housing's not going to bubble next time. So you really have to, real estate, now this is important. Think about monopoly. What did monopoly tell us about real estate? Did it say buy boardwalks because it's going to go up in price? No, because it's got higher rents. That's why you buy boardwalks.
Right.
Quality property, you get higher rents. In the future, real estate's going to go back to what it was before the bubble. The value of a property is the value of the future rents you expect to get, discounted by a risk-free rate, just like stocks, future earnings discounted by a 10-year treasury bond, okay? That's the value of real estate. Whether you're buying it to rent or if you're buying it to own, how much do you save in those rents versus the mortgage and property taxes you're going to pay, blah, blah, blah. Real estate's going to go back to that. It's not going to be, it's just going to go up because it's going up and it's a bubble. The net demand, remember what I said earlier, if you caught this, I had to change my real estate indicator. Instead of just doing a lag like I do for the general economy for peak spending at 46 to 47, 41 to 42, baby boomers, millennials, is the peak home buying cycle. Instead of just lagging for that peak buying, I have to subtract from those peak buyers the people who are going to die, because the unique thing about real estate, unlike any other consumer good, clothing, food, even cars and stuff, is it lasts forever or near forever. So dyers become sellers, and I had to figure this out, Keith, the hard way. I predicted the Japan. I was the only guy on earth that saw the Japan bubble bursting in the early 90s when everybody thought Japan was going to become the number one country in the world, which, by the way, was demographically impossible. But they thought that just because their bubble peaked. Japan real estate did not rebound when the millennials came along. They had a millennial generation, not as big as ours, but still substantial. And it's because those millennial buyers were being offset by dying baby boomers in its higher numbers who were sellers. And you don't even have to sell if you just pass your house down to your kids. Well, that's a home they don't have to buy. So it's supply and demand. So I have a net demand indicator. And what it tells me in every country, though, but in the United States, the message is net demand for houses, even in the next boom, and even with millennials buying for a number of years into the future, is still going to trend down because of the dying of the baby boom. Baby boomers going to be dying into 2039. I'm going to be one of them. I'm going to be dead about 2030. I'm right in the middle of the baby boom.
Hopefully we can end on a more enlightening, upbeat topic than that here.
Well, what it says, though, the real estate investors of the future to make money are going to be people who can rent out real estate at positive cash flow. That's going to be the model. You don't sit on it and just hope it goes up 20% a year for no good reason. That is a bad business model. That doesn't happen except once every 80 or 90 years.
Sure. When you buy for income, if real estate appreciates, that's great. You've got both. But if it doesn't appreciate, as long as you got that income stream, you can service the debt, even if it's temporarily suppressed in value. So you can really play both sides of this. Well, Harry, is there any last action item that one should consider with all these government monetary infusions that we're making into the economy as that props up something like the stock market, which includes non-discretionary things, and rental residential real estate discretionary things? Where's the best place for us to position ourselves in this new government intervention-esque economy?
There's really only two places: cash flow positive real estate, multifamily rentals, and medical facilities are the two things. If they're cash flow positive, I would keep, although I'd still consider selling them if they're valued high enough, but that'll hold up. And the very best thing, and this is not what people would expect, and it's already proven in the first crash in February, March, 10 and 30, the long-term government treasury bonds and AAA corporate, the very highest quality bonds, do not have the default risk that all the other bonds, even B plus or A minus bonds and junk bonds, get crucified like stocks in a downturn. So the highest quality bonds, they get the deflation payoff because it will get even lower interest rates. Okay, you can say, oh, a 30-year bond's at 1.2%. How could you go lower than that? Well, it's going to go to zero, maybe negative like a lot of other bonds. So that bond appreciates, you get some interest. So that's better than cash. So the high quality long-term bonds, cash flow positive, rental real estate, not commercial. Commercial gets destroyed. Businesses are not like people. They just run. They just break their leases or run, or they're not emotionally attached to the house and stuff or the office like people are. So that's it. And then what you do, the leverage comes from rebuying everything from stocks. You rebuy cash flow positive real estate even cheaper into the downturn. You buy stocks, and I tell you when I'd be looking at stocks right now, 2022. I have so many cycles hitting there, including the bottom of the baby boom spending cycle. That's where I'd be looking to buy stocks. I'd be looking at that time, and I'd say, look, I'm not looking for them down 50%. I want them down 80% or more before I start getting serious about buying stock. And then, even in a boom that's less strong, if stocks go from 5,000 in the Dow back to 20 or 30,000, in the next sector, you can make a lot of money.
Yeah, that would be an amazing sale. Well, those are some good actionable takeaways. And Harry, you provided audiences with insights on the economy and especially with how demographics affect that for so many decades. So if someone wants to learn more about you and your work, what's the best way for them to do that?
HarryDent.com. We have paid newsletters of different levels and stuff, but what we say sounds interesting. First of all, I know that what we're saying sounds extreme. I was counter in being so bullish. Late 80s and early 90s, people thought I was crazy. I was discounted for predicting the collapse of Japan. People thought I was crazy. Now they think, oh, Harry, the government won't let this bubble burst. They've said that on top of every bubble. In fact, I was speaking in Dubai in 2007, right before their real estate crashed 50%, and everybody in that audience told me, Harry, the government won't let it go down. They said the government buys the real estate and pumps it up. And I said, well, now I'm really worried, and it went down. So HarryDent.com, you get our free newsletter. And then, we got plenty of other services at hsdent.com. But man, this is the time. I literally think there's a high chance the stock market is peaking early next week or by the election at the latest. Because the first next whack is going to be 40% and ultimately over 2 years, 85%. That is not something you want to sit through even in your 401k plan.
HarryDent.com is where you can get Harry's free weekly newsletter. That way you can check him out and see if it's for you. He has paid products too. To summarize some takeaways for you here, Harry thinks that virtually all asset markets will fall, including real estate. And then among real estate, the cash flow markets will hold up better. And again, this is summarizing what Harry said. I'm not injecting my view here. Stock markets are a leading indicator by 6 months, and they will fall by 80 to 85%. He had some timetables in there. He mentioned demographic reasons for why he thinks a lot of this is going to happen. I'll add in myself that we also have historically high valuations on a lot of stocks, specifically high PE ratios. Harry refers to asset prices symbolizing an artificial recovery. Of course, be mindful that with real estate, you can lock in one of your most substantial price inputs over time. Even if you bought the real estate and the value did go down, you're going to be fine if you've got cash flow and you've also locked in that major price input anyway, that low 30-year fixed interest rate. You still got that no matter what happens. With the cash flowing real estate, I often discuss those places as being in the Midwest and South. The way Harry described it exactly is the Midwest, Southeast, and some parts of the Rockies. He reminded us that age 41 to 42 is the peak home buying age. There are a lot of people of that age currently. They are millennials. And he noted that commercial real estate gets destroyed. I think those reasons are rather obvious. You know, a lot of people don't take the time to learn from the past. If you want to listen to when Harry was here on the show with us the first 2 times, you can listen to those episodes, see his specific predictions that were made. And I seem to remember an exact prediction on the Dow Jones level that he gave there. And you can see how those turned out. Harry was here with us previously on episodes 90 and 119. Big thanks to Harry Dent today. Hey, there is one way that you can be sure that you never miss any Get Rich Education podcast. They will all be conveniently delivered to you in your podcatcher free from anything else, and that is simply to use the subscribe button. Use that feature in your podcatcher. I'd be grateful if you subscribe to the show. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.